Hey, Colin from the Investor Channel here. Going to walk you through reading and interpreting an annual report, SEC Form 10-K. So for an example, I am going to use Coca-Cola Company, symbol KO, a company that we're all familiar with. I'm going to use their most recent annual report, which was filed in February of 2016, and it covers all of 2015. I've included a link to the PDF in the description to this video below. Okay, here we go. First page, Coca-Cola SEC document 10-K. This is an annual report. The first page, you might skim by it, but honestly, there's actually some very valuable information here. Most SEC 10-K annual reports will look fairly similar. They're going to have some legal mumbo jumbo, where the company is registered, which typically is Delaware. You're going to have typically the company logo and some other information. However, I feel down at the bottom of the page, there's some of the most important information there. The very first sentence that I'll have highlighted here is the aggregate market value of common equity held by non-affiliates. Essentially what this is saying is this is the market value of Coca-Cola Company. And I'll tell you in a minute how they extrapolate this value, but the total value is $170.3 billion and some change. So theoretically, if you just was walking around with $170 billion in your pocket, you could buy all of Coca-Cola Company. Now, for the sake of this video, most of you know that that's not necessarily the case, but it gives you a rough value of Coca-Cola's value. Now, the number of shares outstanding is also on this page. This is very important. If you're comparing, this is one reason why you're going to read a 10-K form, is you're going to go to this first page and you might look at Coca-Cola Company over a long period of time, maybe 20, 30 years. One way of being able to do that, if a website out there hasn't already done this, you can look at the number of shares outstanding on each one of Coca-Cola's 10-K reports. You can go back 20, 30, however many years you want to go. You're going to be able to see the number of shares that were outstanding, and you're also going to see the total value of the company at that time. The way the company does this is takes this total number of shares outstanding number, which is at this time 4.3 billion shares and change, and then they multiply that by the total value of the company, the shares of the company, which is the stock price. So they take this $4.3 billion share number, and then they multiply that by Coca-Cola's stock price, which is likely in that $35 to $40 range. And that's how they get that $170 billion mark. Now, at any one given time, that's not that relevant of a number, not necessarily. But like I said, you can go back and look at Coke's, you can look at Coke's market value and how they've increased or decreased the number of shares over the years. That can be very powerful information. Second page is a table of contents. I'm not going to go through this entire document. Obviously, you don't need me going through pages like the table of contents for you. However, what I did want to point out about the table of contents page is once you get comfortable reading and interpreting these annual reports and these 10-Ks, and as you'll find out, 10-Ks are very similar to 10-Qs and S1 filings, and even 8-Ks can be similar. So you will find that maybe this table of contents page here on page 2 could guide you to what you want. Again, very rarely are we going to read this document from first page to last page, unless it's like a school assignment or something like that. Okay, typically you're going to be trying to find one or two or a couple bits of information, and this table of contents page that always appears typically on the second page is going to help you guide you there faster if you don't have kind of a find and replace kind of capability at your fingertips. Next page is actually still says page 1 according to Coca-Cola's documents, but if you're on kind of a PDF reader, it's essentially page 3, but it's essentially item 1, and it says business, and this kicks off almost every annual report I've ever seen. You'll notice this differs from quarterly reports, which usually kick off with some kind of financial statement. Annual reports will kick off with kind of a general overview of the business. And now with Coca-Cola and Apple and Microsoft, I still urge you to read this because you might think you know what Coca-Cola does, and Coca-Cola, how Coca-Cola makes money, but you might actually be surprised in which the manner they do that. With Coca-Cola specifically, they actually sell the syrup and the sugar water to bottlers, which they do not own under this parent company. Now I'm getting kind of into stretches and kind of analysis that we don't necessarily need to get into, but I just wanted to point out, you want to read, there are several pages that it goes through here that Coca-Cola talks about their business model. And I think that it'd be worth going over if this is a company you were trying to invest in, a company that you were trying to further investigate. Now, when you're investigating companies and your reports that you have no idea what their business model is or their sector, the annual report is a great way to do that, because you'll go to these Yahoo sites and some of these other sites that'll give a quick blurb about the company. However, one of the best ways to kind of read exactly their business model straight from the horse's mouth, essentially, is going to this annual report and reading the first several pages that discuss the business model the company makes money under. Okay, I'm going to jump forward. Again, if you want to read through, I certainly consider you to do this. Coke talks about competition and things like that inside the business section. But one section in there on page 10 that I wanted to point out to you was the employee number. And now this is a figure that I typically look for when I'm looking in annual reports. Sometimes you want to know sometimes it's easy to find the total number of employees. But what you want to know sometimes with certain companies is how many employees are working in sales, how many employees are working in bottling, how many employees are working in marketing, how many employees are working in the executive suite. Typically, this employee section, while it doesn't necessarily always break it down perfectly, you usually get a little more detail about the total number of employees and where those employees sometimes work. Not all the time, but if you are investigating a company and you want to know the nature of the employees that it employs, this section right here will often help you find an answer to that question. Now moving forward to page 11 on this document, one of my favorite sections of all time of any company. Using the Coke example here, this is item 1A called risk factors, and you'll actually find this, it might not be 1A on every company, but you'll find something that is called risk factors in all kinds of SEC 10K documents. So what this basically does is walk through, I think, all the disaster scenarios, all the things that can go wrong, all the risks associated with Coca-Cola doing business. It's all laid out here. And typically what I tell investors is if you're looking to invest in a company and you're in love, it's like the first time you're in high school and you fell in love with that girl in class and you were head over heels. And you thought you were going to get married, and it was good. Your life was over. You were going to start having kids right away. Well, if you have that same feeling about a stock, I fully suggest you go read the risk factors. And if you start reading through this, it should alarm bells with a company like Coca-Cola that's $17 billion value and it has obviously a massive brand image. The risk factors can all be taken with a grain of salt. But with startup companies, with penny stocks, with some of these companies that don't have the brand and don't have the $170 billion market cap from investors, these risk factors are real and people are taking them seriously. And I will say some of these are doom and gloom type risk factors. Others are very real, like people within Coke's examples here, not that we're going to go through all of them or any of them individually, but the one that they bring up that is, I think, is very real is more health conscious people drinking less sugar and less soda. That certainly hurts a company like Coca-Cola. Not necessarily hurts them, but they're going to have to adjust and maybe sell more products with less sugar in them or something like that. So those are the kind of thoughts and those are the kind of things you want to get from the risk factors. But I strongly recommend, especially when it comes to penny stocks and very like micro cap stocks that are worth less than maybe $200 million market cap. I mean, there's no hard number, but very, very important that you read through these risk factors, especially if it's a business model that you're not familiar with, especially if it's a business model that might be new or speculative. I strongly recommend you go through all these risk factors and interpret them in your own way. We're going to jump through the risk factor section, but like I said, I strongly consider it important to read that. We're going to jump to item 2, which happens to be on page 22. Nothing particularly interesting about this page. However, I wanted to point out this is where you can find kind of the nitty-gritty on the real estate, a company that you might own. This section is called properties. It may be called real estate or something else, depending on the company. But with a Coca-Cola, you can see they own, obviously, a company of this wealth and this size is going to own a lot of facilities, is going to lease some of them. It's just, depending on what company you're looking into, something like this really might open up some eyes. You might find the length of leases are not favorable. I was looking into, just to give you an example, I was looking into a company a while back that had a market cap. The whole value of the company was worth about $200 million. Well, this company had just signed a lease in a New York office building that must have been incredible. The office lease was for $250 million. So they had a lease obligation that was greater than the market value of the company. So does that make any sense? I don't know, but you can make sense of that. The company's not going to come out with a press release and say, we just moved into a $250 million office building and our company's worth $230 million. That is the kind of stuff. They're not going to talk about that on CNBC. They're not going to talk about that anywhere, except you have to extrapolate these out of these reports. And that's the kind of analysis that I'm trying to teach you here. In properties, you can kind of get an idea what kind of real estate. Well, a company like JCPenney, people aren't valuing, and Sears, those two companies, people aren't valuing the actual business model that they do, but people do value the real estate. So one way of maybe getting an idea of how much that real estate is worth is by digging through those companies' annual reports, finding where those properties are, how big they are, and then extrapolating a value from there. That's what people are doing right now. And I just wanted to show you that. We can stay on this same page. Moving to item number 3, it's called legal proceeding. This is typically what it's called across almost all annual reports I think I've seen. I was surprised Coke didn't have as many legal proceedings as I thought they might have, but this is important depending on the company. Some companies you might look into have no legal proceedings, which may be good, may be bad. It just depends. Other companies, their entire business model, like licensed companies or companies that like buy patents and then kind of patent troll on them, their whole business model is going to be legal proceedings. And you'll find companies where they're suing someone, and then them and that person are then suing someone else. And then those two are suing 3 other people. So people will be suing each other, and then those two will team up and sue someone else. And so it's just a great way for lawyers to make a lot of money. That's what I found. But legal proceedings will kind of give you an idea. Maybe there's, again, this is not necessarily something a company will publicize on a regular basis. So you might want to dig through there. You can then typically there's docket numbers or there's ways to identify these cases down here. Then you can go do a Google search, or go, if you have an attorney or you are an attorney, you can then extrapolate more information from those case numbers. Next page we're going to jump to is page 24, where it says executive officers of the company. This is kind of important if you're not sure who these guys are. Maybe it's a new company, maybe it's an unfamiliar company, maybe you want to identify kind of all the insiders and kind of get a background on them. We got to figure a company, a $17 billion company, is going to have their pick of the litter, so to speak, of executives. So we got to figure, hey, Coke's probably doing a pretty good job here hiring guys. Maybe they are, maybe they're not. But, other companies out there, you definitely, even with Coke, you want to investigate who these guys are. These are the guys that are essentially going to be making you money or losing you money in terms of your share price and the value of the shares that you purchase. So these are the guys guys and girls, that you're going to want to investigate further. And one way to do that is finding the executive page in the annual report. We are going to jump to page 28, which kicks off part 2, which is typically now when we start seeing a little bit more like numbers and stuff. If you're used to reading quarterly reports, which typically have a lot of numbers, a little bit of words, typically, depending on the company. But now part 2, we start actually seeing these financials. Why in the heck do people pay all these why do people pay all this money for shares of Coke? So we'll find out a little bit here. This first page is interesting. You don't see this. I think you only see this page typically in annual report. So it's an interesting page. I think one way you can use this page is you'll notice that Coke has a high price and a low price. And in their case, they have a dividend amount too for each quarter for the last 2 years. And this information may be here nor there, but with a company like Coke, I think what it might do for you as an investor, it gives you an idea of like a range of price you might want to buy in at and sell at, because it's giving you essentially a 2-year price range. So if we look at these values, I've highlighted them here. Over the last year, it looks like to me, once Coke gets up into that almost $44 or more per share, it's not a bad idea to sell, at least it seems like. And whenever Coke gets down into that $36, once it touches $36 a share, certainly looks like a time to buy. Now, this is backwards looking. Who knows, forward looking, if this will hold true. You certainly don't want to go make any investment decisions based strictly on this information. But I think if you're an investor out there and you're kind of wondering, what price should I buy Coca-Cola at? This page right here can give you some information about that. The other little bit of information I have highlighted here is it gives you the total number of shareholders on record, which is just under 250,000 people. With some companies, some very micro cap, very small companies, this number will be very small. And so that's a number that you want to be alerted of. I'm not going to go why that might be a red flag. That might be a case for another video, but that is a number that you can find here, the total number of shareholders. With a company like Coke, doesn't really matter too much. With smaller companies, certainly a number that you might want to investigate. Next page is page 29. This page is more specific to Coca-Cola, but you will see this with companies that are doing buybacks. This essentially is a page that's describing the buyback program. And a buyback, if you're not familiar with that, is the company itself is going to the open market typically, or a market, and buying back shares. So Coca-Cola Company takes the cash that it has on hand, and he's using that cash, instead of buying more factories or more employees or whatever, they're buying back the shares. Now, we could have a long argument on whether that's good or not for companies. The one thing I want to point out to you, as remember on the first page, we said whenever Coke was in that $45, $44 range, you probably should sell. Well, you notice Coca-Cola, they're good at making syrup water and distributing delicious soda. They're buying their stock back at the top of the range, or near the top of the range at 42.47. That again is near top of the range where we're looking to maybe sell Coca-Cola stock, at least in the last 2 years. So just a note here, this is a buyback page. You'll see these on companies that are doing buybacks and that have authorized buybacks. And from my experience, companies are a lot better at running their business, not buying shares. But that's just an opinion. We'll move on. Next page is page 30, and this is one I actually really like this page. You sometimes find this reading through 10Ks. This is kind of the reward to reading, actually doing your due diligence and kind of grinding and reading through these documents that not everybody is reading. Believe me, not all 200 shareholders are reading through this document for Coca-Cola Company. It's even less for smaller companies. This page I find only particularly interesting because the peer group index that Coca-Cola has put together has performed better than the S&P 500 and the Coca-Cola company themselves. In fact, a multitude quite a bit more, I would think. And this is only over a 5-year time frame. The one interesting note here is this really gives you some investing tips. You'll notice that Coca-Cola lists every single company that they put in its peer group. Now, I'm not saying that you run out and build this portfolio on yourself, but it's certainly, if Coca-Cola, I'm sure Coca-Cola spent some time putting this peer group together, or one of their bankers or an expert put this together. So it's certainly something you can look into and notice the performance over the last several years. The S&P 500's done really well over the last few years, and this peer group has done even better. So I just wanted to point that out to you. Moving on to page 31, it has selected financial data. Again, this 10K annual report is typically more kind of words and kind of overview and kind of nitty-gritty details. If you want financials, I'd argue go look for the 10Q, which is a quarterly report. That'll give you a more up-to-date. Again, this is filed in February, and if you're looking at this in, say, November of this year, a lot of this information on the financial side is going to be slightly out of date. So, but it's in here. So if you want to kind of get an overview of what the company's doing, it's in here. Moving on to the very next page, which is page 32, you'll notice this. This is why, it looks daunting, this 100 and some odd page document that you got to read through for whatever reason. Maybe you're an investor, maybe you're a student right now. You got to read through this whole document. It seems daunting, but if you notice here, we go back over our business on page 32. It's essentially going over some of the stuff that we read already. So you can kind of scan through these documents. You'll notice the more and more you go over these things, the companies tend to kind of cut and paste things to make them look longer, or these documents really are way longer than they really have to be or really should be. You can really condense these things down in a short amount of time, and so hopefully you get that from this video. Moving ahead to page 40, this is a page that is not particularly unique to Coca-Cola, but it just happens that their goodwill is big or bigger than almost any company that you'll look at. So it's an interesting page. Goodwill, trademarks, and other intangible assets. Now, that word intangible means you can't touch them. You can't put a value on the Coca-Cola logo or the Coca-Cola brand as a whole, but obviously it has value. If we could just sell that part of the company, somebody would buy that. And so the way the company puts a value on it is probably more high level than what we need to go into this video, but essentially they're putting an $11 billion valuation on this asset called goodwill. Now, as a side note, if you're just a beginner kind of reading financial documents, typically with these larger companies, even smaller companies normally, the values are going to be in millions. So you see this 11, it literally says 11,289. The more and more you read these documents, you'll realize that's a huge number. It's not 11,289. That's 11 billion, 289 million and change for goodwill. So that's what the company values it at. They have some other franchise rights, some other trademarks here that are obviously very, very valuable as well. But the one thing I wanted to point out here with Coca-Cola, yeah, you know that the Coke brand is worth something. I've looked into some of these companies I've never heard of, and they're in their value. Half the company market value is in goodwill or in some kind of intangible asset in this company no one's ever heard of. So you want to just really, that's where you could really start to use these 10K and annual reports and even the quarterly reports to your advantage as an investor. Doing your own due diligence is you can say, oh, okay, this company is valued at 40 million, but 25 million is in this in something called goodwill for a company no one's ever even heard of. And if the company wiped off the face of the earth, no one would even care. Whereas Coca-Cola, it's different. Coca-Cola all of a sudden went poof tomorrow. The brand and Coca-Cola would still be worth something. People would recognize that. That's why there's actually a tangible value with that. Whereas with other companies, you'll look at the goodwill line and all the intangible assets. I would argue that it's typically way, way overinflated. Moving on to page 49 already. This is a statement that you'll see more often in quarterly reports, but certainly something that you need to analyze before investing in any company. And this is the consolidated statements of income. Now, these will be broader and more stretched out in more detailed reports, but in this case, I'll probably have a video later on that covers analysis of just this piece of information, but just right quickly here, the one number that you're always really looking for right away, in my case typically, is net income. And net income basically means profit, essentially. So with Coca-Cola Company, I have it highlighted here. They typically make in a range of $7 to $8.5 billion. Remember, these numbers down here are in thousands too. So it says Coca-Cola made $7,351. We know that that's not the case. This is a big company. Those numbers are in millions, and so that's actually $7.3 billion in 2015. That's the number that I look for right away. Typically, companies that aren't doing well are going to try to bury that number or try to adjust that number or show you all these other numbers, adjusted GAAP, adjusted EBITDA, adjusted OIBDA, all these other numbers to not get you to pay attention to the number that really matters, and that's the bottom line, which is called net income. Moving forward to page 52, nothing specifically about this page really jumps out at me except net operating revenues by operating segment. Now, a company like Coke is doing business in Asia, doing business all over the world, and they have all different kind of brands and stuff going on. You'll notice a lot of other companies are very similar. They'll have different segments. Some segments might be doing better than others. Some might be growing. Some might be shrinking. Inside these annual reports is sometimes, if the company doesn't break this out for you on a quarterly basis, going back to the annual report might give you a better sense of that. So I just wanted to point that out to you. Moving on to page 53, this is when it starts getting exciting for me, because this is when you start getting into the nitty-gritty expenses. Companies do not normally put out press releases about expenses. CNBC and Bloomberg are not going over a company's expenses in any great detail. And you'll find a lot of waste, a lot of money being spent by companies in this selling, general, and administration expense. Sometimes it's called SG&A for short, and you'll often find this is one of the biggest expenses because it typically includes stock-based compensation. It includes, here in Coca-Cola's case, it's including advertising, it's including selling and distribution, and then there's this other line, other operating expenses, and it's $6 billion. The cool thing about annual reports is you can typically then dig into this annual report and figure out, well, they say other operating expenses. What does that actually include? You can actually dig through this report and actually find out what that is. And sure enough, on the very next page, page 54, you'll see a page called Other Operating Charges, and they break it all down here for you. What that whole amount, what all that kind of incorporates with a company like this. Now, you want to do that exact same thing when you're looking at any company you're looking at, not just Coca-Cola, especially these smaller companies or these upstart companies with no track record, no dividend, no way to pay you off other than the shares appreciating. You definitely want to dig in here and see how these guys are spending money. I'll be honest, I've looked into these expenses. Typically in companies that are long gone by now. I've seen Mercedes SL 500s purchased. I've seen a beach house in Venice. It's a software company, and they're buying a beach house in Venice and Mercedes. This happens. It's all inside these documents. They're not going to do a press release and say, hey, we just bought ourselves a beach house with shareholder money. But you're going to have to dig into it. A company like Coca-Cola, you better believe, is not doing stuff like that, at least not on the real up and up surface. but or the top surface. But these smaller companies that are kind of scams and kind of fraud almost, or definitely fraud in some cases, all that stuff's in the documents. You need to read through them. Jumping forward to page 61, you'll typically see a page like this on almost any annual report. It says liquidity, capital resources, and financial position. Basically, this is the company giving you their opinion on this. Now, Coca-Cola, $17 billion company, a decent amount of cash, $7 billion in sales or net income, $7 billion in net income. They're doing just fine. In fact, their first sentence says they believe that's one of their fundamental strengths, and I likely agree with them. It's hard for competitors to compete with them when you have $7 billion in net income and you have all these distribution channels. Now, for other companies that you might look into, you might see a really grave statement here. Not one you're reading this company's press reports and it's, oh, we're going to take over the world. But then you go to their 10K and you read the liquidity, capital resource, and financial position, and the first sentence says, we'll either need to raise money or we're out of business in 6 months. I've seen sentences that basically say that. You go to the press releases, the company makes it seem like everything's great and everything's rosy, and then you read what they think about their financial position, and it basically says, we'll be out of business if we don't raise more money or a miracle happens, basically. So typically, in big, large companies, this isn't a big deal, but I will urge you, small cap, micro cap, penny stocks, please read this statement before you buy any shares. On to page 63. This is a page I find myself digging through quite a bit on companies that acquire another company, or they're buying companies, or they're building up their business kind of in a roll-up strategy. A roll-up strategy is by buying a bunch of businesses and kind of rolling it up into a much larger business. You'll see that a little bit in public stocks. Now, Coca-Cola specifically has kind of joint ventures, and they've acquired smaller drink companies and smaller brands over the years. The most important thing is again, you'll get a press release from Coca-Cola or whoever does an acquisition, and they'll make it seem like it was the greatest deal in the world. But typically there's all kinds of little clauses and little deal makers all along the way there. Inside these annual reports, typically, sometimes in the quarterly reports, but typically in the annual reports, you'll see the deal kind of outlined completely here. So you get the full consideration. Typically these deals are announced. Again, a company will do a press release, but over the next couple of weeks or months or maybe even years, that deal changes typically. There's all these different add-ons, or the valuation change, or there's these earn-out clauses that if the company does really well or doesn't do well, the owners pay even more for that acquisition or don't have to pay as much. So that's where you get all that information, especially if the deal goes bad. If it's a bad deal, the company's not going to advertise that. They're not going to say, oh yeah, we made a bad deal, we overpaid. But they can't hide that in the 10K. And that's all, again, this is all due diligence. What I'm teaching you on this video is the fundamentals of due diligence. This is what people do that are professionals and that take this very seriously, investing in companies. They read through these documents and then they extrapolate their own value. They don't just look at the ticker on the screen or listen to some fool on CNBC and then go buy the shares based on what he says. That's what lazy people do. The 1% reads through these documents, or actually those guys pay somebody else to read through these documents, but you get what I'm saying. But to wrap up my point on this page 63, really it's a page where you can really dissect the deals. A company acquires another company, you can really dissect, hey, was that a good deal? Because now you can see what they paid for it, what that company now adds to the bottom line or top line of a company, and you can kind of extrapolate, hey, was this a good deal or was this a bad deal? Moving forward to page 64, I wanted to point this out, cash flows from financing activities. This is when a company refers to doing financing activities, they're doing exactly, think about it as you as like a consumer. your financing activities might be going to the bank and getting a loan for a home, or getting a loan to buy a car, or getting a credit card so you have a little bit of credit. So just in case you need to make a purchase or something and want to pay it off over several years. Coca-Cola does the same thing, guys. Just because they have $7 billion in net income doesn't mean they want to spend that all running their business. So they have issuance of debt. So they actually issue debt. Then they have to make payments on that debt. They have issuance of stock, which might be, in some companies' case, might be to actually raise money. They're issuing stock and then taking that money in to run the business. Almost all companies compensate their executives and then sometimes employees with stock, and so they issue stock for that reason. Purchase of stock for treasury, not 100% sure what that is. Dividends, this is an important line, especially with companies that might be struggling, might be paying a dividend, and then the business model changes or circumstances changes where they might not be able to pay that dividend, or the dividend becomes a burden. Here's where you can get the kind of the exact value on dividends. And notice the negative numbers on any of these reports. If you're not familiar, again, this is real basic, but a number with a parenthesis around it basically means a negative number, or in Coca-Cola's case or a company's case, that money went out. And so this dividend, you collected that as a shareholder, but Coca-Cola, the company, had to pay $5.7 billion in dividends last year. Finally, page 71, we get an overview of financial position. Now, this is not a red flag on an annual report, but I will say, this is, again, my own little opinion slipping in here, is on quarterly reports. So the 10Qs that the companies release every 3 months, if they're burying the financial position all the way down at the bottom, to me, that's a red flag. It's not a automatic red flag or a fraud alert or something like that, but it would make me pause and say, why is this company burying this all the way down here? But in these annual reports, burying these financial documents is nothing out of the ordinary. So this is this is a kind of a separate video kind of going over this, but and again, if you're analyzing this in November, these numbers are back from December 31st, 2014. So they might be a little out of date if you're analyzing the company from like its point forward. However, if you're going to compare Coca-Cola maybe back through the 70s and 60s all the way up until the current date, you can go back through all of their annual reports and kind of dissect the information from this page. It's probably not going to be page 71 on all the documents, but you can kind of get an overview of the financial position of all companies in their annual reports. Again, it's something that I recommend looking at, but if you want the most up-to-date current numbers, try to find the most recent annual report or some kind of 8K that has that in there, or you can always email or contact an investor relation firm of a stock, and if they're worth anything, they'll send those to you promptly. Moving forward onto page 74, we finally gotten to item 8, the financial statements and supplementary data. Here is where if maybe if a company had a lot of this stuff, typically it's not a ton of stuff here, but if they did have some document that you're looking for, specifically this table of contents can help. But let's roll through some of the things you're going to be able to see in this section. Page 75, if you've been paying attention, we've seen this page before. Again, these 10Ks, you don't have to feel like, don't feel like it's a daunting challenge to get through 100 and some odd pages here. Okay, it is a daunting challenge here, but you'll notice that they repeat this stuff over and over sometimes. And so this is a consolidated statements of income. Again, there's lots of things you can extrapolate from this, but what I typically look at right in the beginning, at least what jumps off at the page for me for about any company, is this net income. And sometimes that's followed by attributed to shareholders of the company. And again, we see here that Coca-Cola is doing just fine, generating $7 billion and change in net income for the last 3 years. Moving on to page 77, I don't think we've seen this in its full form yet. We've seen all the little pieces of this balance sheet, but we haven't seen it all spread out here. So if you're really comfortable reading balance sheets, that you're going to feel comfortable when you actually see this page with all of it kind of wrapped into one. So you get a full sense of the assets, the liabilities, and kind of the full picture of the Coca-Cola company here on page 77. Next, page 78, we've got, again, we've seen this probably in little bits and pieces. Now we have the whole form kind of coming together. Again, the reason why they bits and piece it out in these annual reports is typically there's an explanation that follows underneath that. That's why these annual reports are really important, because you'll look at a statement like this on cash flows and maybe you'll see a number that jumps out at you here, maybe stock-based compensation or something, or deferred income taxes. One of those numbers for whatever reason jumps out at you, and now you can go back and look and see in that section on these annual reports, hey, what does that number mean? Why did that number go up? Typically, the company will give you some kind of, usually kind of a vanilla explanation about why it went up or down. But again, you can then do your own analysis from there. But on page 78, we've got a whole consolidated, as it says, statements of cash flows. Basically, cash flow means exactly what it says. It's the cash flows coming in and out of the company, and this kind of gives you that full sense of that. Moving forward to page 97, if you're flipping through the document as I am here, you'll notice the next several pages are kind of somewhat repeats, somewhat going over information that you have already seen in this report. Again, that's the beauty of these reports. They look super long, but a lot of the information is kind of gone over 2 or 3 times. They might word it differently, might say a few different things here and there, but typically you're going to be able to find, especially if you're doing find and replace, kind of finding certain words in these documents, you'll notice as you do that more and more and over, you'll notice that these documents tend to repeat themselves. One note on page 97, this is actually called Note 4, Inventories. Now, this is really important, in my opinion. Again, this is just my opinion. I think this section is really important. Probably with a company like Coke, you wouldn't want to see them get backed up with a lot of inventory, although again, it all depends on the company. Where inventory really matters in the companies that I've looked at is clothing companies, fashion companies. So a company like Nike, or a company like Gap, or a company like Limited Brands, or Victoria's Secrets is kind of their number one brand, essentially. So the reason why I think inventory is so important in those companies is they have to churn through their inventory. There's styles, there's seasons, and there's fads, and there's all this stuff going on in fashion. And so as an inventory, they don't want to get stuck with inventory. The other business model that I don't think you want to get stuck with inventory is like technology or like electronics. You wouldn't want to see an electronics manufacturer get stuck with electronics because typically they have a limited shelf life. I mean, the iPhone 1 came out in 2007, and if you walked around with it today, you'd be laughed at, but it's not really that old. It's not that, it's only 9 years old at this point. That's not that old. Even people with iPhone 3 and 4, you've kind of been pressured to move up the ladder and get a newer phone. So my point is with inventories, you can get a sense, and this is where the comparison really makes sense. You can compare year over year, or if they break this out on a quarterly basis, you can break it out on a quarterly basis. And with a retailer, you want to make sure you factor in, hey, they're going to ramp up inventories before Christmas, and hopefully they're going to exhaust or sell a ton of that inventory during Christmas time. And if they're not, that could be a red flag, could be something to investigate further. So I wanted to point that out. Page 97, typically in these annual reports, you'll find an inventory number, and you'll have raw material, finished goods, and other. And then again, you may not know what raw material is based on the company you're looking at. You might not know what finished goods are. Keep reading down below, keep investigating. You'll be able to find that inside this document, what raw materials actually consist of, what finished goods, again, what the company's definition of finished goods and raw material is. It's going to vary from company to company and business model to business model. Sliding forward to page 107, and it carries over into 108, is debt and borrowing arrangements, note 10. So it has short-term borrowings and long-term borrowings. Companies are going to borrow on both those bases. I don't think those are necessarily something you need to get wrapped up in. The one important part about this is it really explains the interest rates and the terms of these loans. Again, companies are going to come out with a press release and say, hey, we got a $10 million, and they'll describe it maybe as a line of credit or an advance or something. Basically trying to avoid the word loan or debt or kind of a negative word. And so you're going to be able to discover all kinds of little nitty-gritty stuff, especially in those little penny stocks that are like borderline fraud. You're going to find all kinds of little borrowings and transactions down in here. This breaks it all down. Coca-Cola, I will say, just scanning this really breaks it down really cleanly. They have obviously a lot of debt, or a good amount of debt, but for a company this size, it's not something, again, it takes further analysis, but in my opinion, just on the surface, nothing to really get alarmed at. They break it down, in my opinion, very, very nicely. They show you exactly how much when they are due, the interest rates. Some companies, they like to really be sly about this. So you might have to you really have to extrapolate sentence by sentence, word by word on some of these guys, because they try to word it as confusing as possible. To be quite honest with you. But the most important thing for you to understand is these long-term debts and all the debts and the loans of a company is all going to be broken down here in kind of plain English here about the term, when it's due, how much, and the interest rate. Should all be broken down for you in the company's annual report. Moving forward to page 138, Coca-Cola, I skip some pages. They go through their pension plan and all this employee stuff. That's not something, pension plans and stuff like that is stuff you're only going to see, obviously, with the really gigantic companies and companies that have pension plans. A lot of companies don't even have those anymore. So that's something I don't have a whole lot of expertise kind of interpreting and reading, but certainly that could be a risk factor. That could be a reason, something to dig into. And I'm not saying to ignore it, but I'm just saying for the sake of this video, I will say that a lot of the 10Ks you're going to go, unless you're just investing in only blue chip names, you're not going to see a ton of pension plan stuff in there. What I will have you move forward to is page 138. This, again, I've gone through this and said, hey, you can go through the annual reports for the last few years and kind of see a trend. Well, what the companies typically do in these annual reports is they might do this for you. And so on page 138 if you're trying to do, maybe as a student or even as a research analyst, you're trying to show a trend of their operating income, or you're trying to show the trend of, here they break it out per country. And so you could show the European trend or the Latin America trend or the Asian Pacific trend of the company in a certain metric, or all the metrics, or whatever you want to do. It's all here for you, so you don't have to go back through necessarily and pick it all out. Now, you will have to do that for certain numbers that the company don't want to highlight, but I just wanted to highlight that before you go through and maybe dig through 5 annual reports. To do this, scan through the whole document, and you might find that it's already kind of laid out there for you. And folks, that is about it. In about 45 minutes here, we've learned how to read through an annual report. The last page, on the last couple pages, typically covers some signatures, an auditor, and some other kind of legal mumbo jumbo there. But typically, my last final tip here is I love to go through the ends of these reports. Sometimes instead of reading the beginning, I go all the way to the end, because I figure the company probably figures very few investors are going to get to the end. And so they're going to bury something down in there. They're going to bury some text. A company like Coca-Cola, maybe not necessarily. Some of these other very smaller companies, penny stocks, companies that are trying to hide something or trying to cover up mistakes that they might have made, or many mistakes they've made, are going to bury that at the bottom. And so last tip is just read through the whole document. Make sure you focus as much on the beginning as you do the end. If you lose your focus halfway through, just leave it in your browser, walk away, go grab a Pepsi or a Coke, and come back refreshed and and go ahead and go through the document, fully aware that towards the end, sometimes you can, again, this is not all the time, I'm generalizing here, but sometimes you can dig up some interesting stuff towards the bottom of these documents, because these CFOs and CEOs know that burying it down there is probably better than putting it at the top. Folks, thanks for hanging with me this long. If you have any questions, please leave a comment. You can message me here on YouTube. I am, this is my job. My job is to analyze stocks. My job is to write about them. My job is to basically inform the public that doesn't want to go through these documents about what's in them. But my job here today was to try to teach you guys. You guys are all smart enough and you're all fully capable of doing it yourself. This is the very basics of due diligence. You don't need to be a millionaire. You don't need to be a business graduate. You don't, although I think that helps. You don't need any really formal training other than the effort and the education it requires to learn these things. Thanks for hanging with me this long. Please subscribe and like this video if you've enjoyed it. We'll see you guys another time.